Good afternoon. Welcome to the webinar hosted today by the Investor Responsibility Research Center Institute and the Stevens Institute of Technology on a new report, High Frequency Trading, a white paper, and an innovative solution to address key issues. On our agenda today is introductions, the IRRC perspective, an overview of the research, and we'll take your questions. Just a few words on logistics. All the attendees, except for the speakers, are in listen-only mode. Questions will be encouraged. Throughout the webinar, there is a question function drop-down window that you can type your questions. At the end of the presentation, we will take your questions. We can either read them aloud, the questions you've chatted, or we can open up your phone line if you let us know by questioning us, and you can have a conversation with the speakers. You'll receive an email after this webinar with a link to the replay. This report and all the other materials are already posted on the IRC Institute website, and this PowerPoint will be posted as well. We encourage you to share information on social media about the report and the webinar. And if you have any audio issues during the webinar, please contact GoToWebinar at 1-800-263-6317. Our speakers today are John Lukomnick, Executive Director of the Investor Responsibility Research Center Institute, and also Khaldoon Koshanan, PhD, the report lead author and distinguished professor with the Financial Engineering Division of Stevens Institute. Dr. Koshanan has been unexpectedly delayed, so we hope he's going to join us shortly for the webinar. In the meantime, John will take the lead on providing the overview of the research. Just a few words about the Stevens Institute. It was founded in 1870. It's a premier private research university. It's known for its technological innovations, and it's home to 4 national research centers. About the Investor Responsibility Research Center Institute, we're a nonprofit established in 2005. Essentially, what the Institute does, it funds and disseminates research on a range of topics at the intersection of corporate responsibility and the needs of the informational needs of investors. We sponsor our annual research award. We have a 5-year impact report that you can download on the website to get more information about the organization, and all the research is available at no charge. Here's just a short list of some of the research reports that the Institute has released over the years. You can see it's a broad range of topics, everything from hot topics to cybersecurity to insider trading, environmental issues, executive compensation, and hydraulic fracking, shale gas issues. So you can take a look at that research at your leisure also. And with that, I will turn the webinar over to John Lukomnick, and he will give the IRRC's perspective and an overview of the research. John?
Thank you, Kelly. I do want to mention that I am pinch hitting here for Dr. Koshanan. And I apologize in advance if, obviously, my level of technical expertise will not be as great as his, since he and his colleagues at Stevens did the research. That being said, I am familiar with it, so let's walk through it. About 1.5 years ago, we put out a request for proposals for someone to do a paper that we colloquially inside we're calling what non-high frequency traders have to know about non-high frequency trading. This was long before Flash Boys came out, but high frequency trading was then and is still now a very controversial practice. And we were very pleased with the paper that Stevens Institute produced. It does both that, and then, as you will see, goes on to propose a solution to some of the more controversial aspects of high-frequency trading. So the first thing that I would say is that the research dispassionately parses the previously existing high-frequency trading research and adds to it, as you will see in the methodology section, with some primary first impression research. It finds that high-frequency trading does provide liquidity. It does increase liquidity in the marketplace, but on a systemic basis, largely for large cap, already liquid stocks. Liquidity is only provided to small cap stocks on an opportunistic basis. It does, however, find that HFT creates some unfairness and allows some firms to take advantage of information asymmetry to trade by arbitraging some of the microstructure aspects of how orders are placed and filled. What's interesting is that the research solution focuses on first principles, fairness and access to information. This is the basis of, for instance, regulation NMS from the SEC, not on whose advantage. So it doesn't try to demonize or make into an angel high-frequency traders or non-high-frequency traders. It tries to say, here are the principles. What does this innovation do to those principles? Additionally, it tries to pay attention to free market principles, and so it does not require a change to market architecture. Next slide, Kelly. The solution that they came up with is something called information transmission zoning. We'll get into that in more detail, but basically it says if you are in a zone where you can get market price information prior, and in this case I'll use market price information as a shorthand for order flow as well as price, prior to it being available to the general market through the source of a SIP or an NBBO, then you have some sort of information asymmetry. Now, many of the high-frequency firms, when you examine them who operate in this information zone, actually have return patterns that look like they are benefiting by providing liquidity. There's a name for that. It's called a market maker. And so what Dr. Kashana and his colleagues have come up with is the idea of creating a zone. And if you're in this zone, you basically have to obey market maker rules. You can benefit from providing liquidity, but you can't be on both sides of the trade. You can't front run an order. If you're outside the zone, then you can be a trader. You can use proprietary algorithms. You can do whatever you want. This is the point that normally I would turn over to Dr. Kashana. Kelly, I assume he has not joined us yet. And again, I apologize for that. But let me go through what their methodology was on this report. First, they did do an overview and study of all the existing literature and put it into a taxonomy. I actually quite like this because it starts to differentiate the issues. The public press on HFT is extensive, but it's often confusing. There's a lot of heat and fairly little light. So this goes through trading behavior, what the order book dynamics are, what the impact on price discovery is, the financial economic impact of it, and starts to disaggregate all the issues in an understandable taxonomy of what's going on with high-frequency trading sort of as a subset of algorithmic trading. Stevens Institute also for 5 years has run a conference on high-frequency trading, so it has unparalleled access to insiders, academicians, practitioners, and regulators, and they surveyed these three key constituencies. It also received from NASDAQ a sampling of trading data and coded it to see if the size of the trade were high-frequency traders or non-high-frequency traders, then further broke it down to see what types of stocks high-frequency traders were trading in, whether it was liquidity between high-frequency traders or liquidity that high-frequency traders were either providing or taking from non-high-frequency trading. And then, as I said, using these basic principles of access to information and fairness and being as minimally disruptive to markets as one could be, they have done an analysis of the proposed solutions. I would urge you all to look at the actual paper. There are two versions. There is the academic paper, which is very detailed, and there is a practitioner's guide, which is still fairly detailed but tries to make it more accessible to the average practitioner. Next slide, please, Kelly. So as I said, their entire background is what are we trying to do here in the marketplace rather than who wins and who loses. Um, so they are managing the principles of financial markets. You want liquid markets, you want fair markets, you want access to information to be fairly accessible. I know that's a redundancy, and I apologize for it. Um, and what they came up with was information transmission distance and zoning as an optimal solution. Let me explain what that is. Next slide, please, Kelly. Before we do, I just want to say, remember this started as a what non-high frequency traders should know, and so there are some generalized findings to begin with. One of the things that is obvious when you say it but isn't often noted is institutional investors, meaning non-high frequency traders, have the vast majority holdings of equities. They have the most capital at risk by orders of magnitude. But high frequency traders who try to end with basically a square book and no capital at risk are the major determinants on a moment-to-moment basis of price, particularly for large cap stocks. Whether you find that to be an inequity or problematic or don't is up to you, but it's a baseline fact worth remembering. Secondly, as I said, high frequency impact on liquidity varies between large cap and small cap. And third, the practices which are most controversial, quote stuffing, the high percentage of orders which are canceled, is predicated on asymmetric access to information. Next slide, please, Kelly. Now, unfortunately, as I said, the public press and the overview of the debate has conflated four distinct characteristics. Three of them, the researchers found not to be a problem. One is technology is an enabler. Obviously, there are people who don't text message. Going back to the Industrial Revolution, you had the Luddite Revolution against industrialization. Technology is an inevitable innovation in today's society. The researchers found it somewhat not just problematic, but non-realistic to think that you can just stop it. And technology as an enabler is not an issue in terms of fairness or access. People have moved from having to be present under the buttonwood tree to having a telephone connection, to having telexes, to being able to place orders by computer. It hasn't engendered this sort of debate. So we want to take out technology as an issue. It's just not an issue in terms of fairness. Location and time scale. This is the co-location issue. And do you get a advantage by being in the Mahwah, having your computer in the NYSE Mahwah computer farm, for instance? The issue here, again, isn't really where you're located. One could argue that fundamental non-high frequency, value investors or growth investors who have offices in New York City get an advantage over having your office in Indianapolis because more corporate managements come through and you see them. Not really an issue of location and time scale. Algorithmic trading strategies independent of time scale, these have been used for years. Again, I think sometimes people conflate algorithmic with high frequency trading. You could have an algorithmic trading strategy that spreads trades throughout a day. The most common is some sort of thing to make sure that that fundamental traders are getting good execution, measured against VWAP or volume weighted time or some other thing. It's not an issue. So the issue really does come down to, is there an unfair advantage through having, let's call it asymmetric information to the microstructure of the order flow, and can you manipulate those quotes? Next, please. And what they came up with was information transmission zoning. This is a combination of time, distance, and technological ability. Let me give you an analogy before I explain it directly. I live in New York City. if I wanted to go to Yale in New Haven, and I ask someone how far it is, the answer people will often give me is an hour and a half. Now, an hour and a half is obviously a measure of time. It's not a measure of the 75 miles between New York City and New Haven. What people are doing when they say an hour and a half are assuming what route I'm going to take. They're saying it's approximately 75 miles. They're trying to determine how fast I drive, what the traffic conditions are like, and they come up with time as a measure of when I can get there. But of course, it varies. It depends if I'm going on I-95, which is the interstate, or the Merritt Parkway. It depends if I obey the speed limit. It depends if I have a Lamborghini or a 20-year-old jalopy. Similarly, what Dr. Kashana and his colleagues did was say, whether you're in Mahwah, co-located, or San Francisco, whether you is one variable, how far you are. The amount of time it takes information to get to you from the securities information processor to your computer is a function of several things. It is a function of distance, but it's also a function of technology. What sort of, do you have optics? Do you have hollow fill, fiber? What's the transmission protocol that's being used, etc. And so what they do is they say, there's a red zone. This is the zone where you are getting the information prior to it being available for national best bid and offer. It would be the equivalent of, in the old days, being on the floor of an open outcry market. You are getting it quicker than that is getting out to the rest of the world. Next slide, please. So to put it in the terms of high-frequency trading, information transmission distance is defined for these researchers as the sum of the intrinsic latency. So that is usually a function of distance times the speed of light, right? How fast can you get someplace, plus technology latency. Do you have a jalopy or a Lamborghini? Are you using copper wire? Are you using hollow fill? What are you using? What's the transmission protocol? And so what you can do then is, given an exclusive source, a securities information processor, and an HFT unit, you can measure what the information transmission distance is. And you only have inside information if you're within this red zone, and the mathematical formula is the distance has to be greater than 0. Next slide, please. So what they find is that the information transmission zoning criterion basically can be used to separate high-frequency trading market makers from high-frequency trading traders. That classification is very consistent with the intent of Regulation NMS. What Regulation NMS doesn't have is a standard for defining who's a market maker. So you would need to have this defined as a standard, and that formula on the previous slide basically is the definition of who would be a market maker and who wouldn't. Now, you could choose to move outside that zone if you wanted to trade, and outside that zone could be, a nanosecond. But as long as you're outside the zone, you're outside the zone. The authors do not believe there is a need for a major change in regulation, just for the standard to be applied. And that would allow Reg NMS to regulate without changes to market architecture, without batch processing or some other sort of change to market architecture, which might have an unintended consequence elsewhere. It would enable all the benefits of liquidity provision and algorithmic trading to occur while mitigating the unfairness aspect. Next slide, please, Kelly. So the information transmission zoning determines what the latency is, which determines whether or not you get your information prior to everyone else. If you are below the systemic latency of getting information to the rest of the world, then they're e-specialists or market makers. If you're super systemic, you're a trader, whether you are a once-a-year trader or a several thousand time a day trader. You can, using this conceptualization and formula, define each information source, each computer, and whether or not you are subsystematic or supersystematic. Systemic, my apologies. Subsystemic or supersystemic. Next slide. So basically what they have proposed, and again, this is part of the guide, but it's the part that has gotten the most attention, is that if you introduce this concept of information transmission zoning, it will enable fair competition access, but it will also not destroy the positives of high-frequency trading, such as the systemic addition of liquidity, particularly to large capitalization stocks. I think that's it, right, Kelly?
Yes.
Again, I apologize for Dr. Kashana's unexpected accents. For those of you who have a deeper technical knowledge than I do refer you to the paper, but I will try to answer any questions that anyone may have.
Okay, just as a reminder to everyone, if you have a question, we'd love to hear from you. You can type a question in the chat box and I can read it aloud and have John answer it. You can also type a question, open up my phone line, and I can unmute your audio mic and you can have a conversation with John. The first question we have is, how does your proposed solution differ from that of the IEX as proposed in FlashBoys?
So the main thrust of the solutions that have been proposed have tried to deal with this information asymmetry and access to order flow before everyone else by, in effect, creating artificial barriers to how quickly you could act on those trades. There's a great paper out of the University of Chicago that talks about this. And what that does is say we're going to aggregate all the trades into batch. Remember when computers first started, we had batch processing versus continuous processing. And even at the sub-minute, sub-second level, this would in fact remove any information asymmetry. The problem that the authors of the paper find is they're unsure what it will do to pressures on the marketplace, whether or not you could game that system, for instance, with an off-market derivative that would trade micro frequency and a bunch of other things. So they are trying. I think they're both interesting approaches. I should say the IRC is not an advocacy organization, so we encourage regulators and academics to look at all approaches. But the difference here is that they're not trying to change the market architecture. They're only trying to apply the regulations as it now exists. And what they are really trying to do is provide a standard to allow that regulation to be effective in regulating who's a market maker and who's a trader.
Thanks, John. We have a couple more questions in the queue. The next one, what has been the reaction, if any, from industry on your proposal?
Well, obviously, let me say, first off, this is hearsay. I did speak to Professor Kashana yesterday and actually asked him that question. And I guess what I'd say is the jury is out. The people, and so this is hearsay, but what Dr. Kashana tells me is that the industry liked the proposal by and large. But because they thought it would have less impact than the proposals which restructure the market architecture. So all the aspects of it are familiar to them. Now I say that it's always wonderful when someone comes up with a brand new solution, and zoning here is a brand new solution, but it's so intuitive that it seems obvious, so that it doesn't seem different. And that's what's happened here. What's necessary to make it work, though, is this definition of a standard how does one define who's a market maker and who isn't?
Hello.
And hello,
Oh, looks like
we're
we have
into
Dr.
Q&A.
Welcome.
Dr. Kashana has joined us. So if anyone has technical questions, they can now ask them. We've run through the presentation. So that is what the industry, by hearsay, the question to us, Dr. Kashana, was what has the industry reaction been? So why don't I let you answer that as well?
We're picking up some background noise from you, Dr. Kashana. And
There is background noise?
yeah, I think it sounds okay now.
Okay.
Okay, can I move on to the next question, John?
Sure.
Okay. The next question, are you speaking with the SEC? What are you at in the translation? Where are you at in the process of translation from research to practice? Any comments there?
Khaldun?
Sounds like he's having some audio problems now.
Any reaction, Khaldun, to that? We have not spoken to the SEC. Obviously, this has been covered by CNBC. The SEC is doing some research on the general area. I know Dr. Kashana has spoken to a number of industry people and has spoken not to directly. You've spoken to other regulators in Washington, but not the SEC. Is that correct?
We may have lost his audio.
We may have, yeah.
Okay, we have another question. Is there any reasonable way to quantify the cost of HFT trading in large cap equities on institutional investors? If so, what kind of ballpark cost are we talking about for U.S. institutional investors?
This is, again, I think that if you read the paper in terms of the literature review, they do cover this. Some people would say that it has saved money. It's not a cost, it's a saving because of the liquidity provision. Other people would look at it and say, look, if payment for order flow is in the billions of dollars, that is money that has come from somewhere, and has that come from institutional investors. This paper did not, and IRC Institute has not done that quantification ourselves, so that's about as far as I'm going to go on this.
Great, and that looks like all the questions in the queue. We thank you all for joining us this afternoon. If you have any questions or comments, please feel free to get in touch with us. Our contact information is listed there. Again, this webinar, a replay will be reposted later today, and all the materials are on the website. John, did you want to say something else?
Yeah, Kelly, if I could, I again want to apologize for the unexpected issues here. And I would encourage you to read the papers. I think they're really good. They, I think, do a very good job of unpackaging what is a complex set of issues to focus on the fundamental principles. And I again want to thank Dr. Kashana and his colleagues at Stevens for them. We will probably also be doing some sort of event to discuss this in Washington towards the end of the year, and we'll make sure that everyone on the webinar gets notice and an invitation.
Great, and this concludes our webinar. Thank you for your attention and your interest, and we hope you have a terrific day. Thank you.